Hey everyone, welcome back to Surer Gains channel. Thank you so much for subscribing to our content and for supporting us. And on that note, let's begin. Have you ever heard of the phrase, you can't have your cake and eat it too? It sounds absurd, right? Well, it basically means you can't have it all or you can't have it both ways. But why not? Today's youth begs to differ. Today's youth wants to have it all. Today's youth wants to have it both ways. And they don't shy away from working hard, but they truly believe in working hard and partying harder. So let's see, can stock markets in India yield high returns but with less risks for young investors? In the recent years, large number of new investors have started investing in the Indian stock markets, and significant proportion of new investors comprises youngsters. A number of young investors is also increasing steadily. Those people who entered the markets during COVID period a year later made significant gains, but after that the market went into correction phase for a long time. And in fact, after the initial post-COVID recovery and the subsequent bull run in the market, many had to face major setbacks. But these setbacks should not make one quit stock markets completely. The setback may be treated as a learning curve and one should take required precautionary measures in future. Well, when it comes to the basic principles of investment are same for everybody, but youth have more time on their side to bounce back from setbacks. They also have more time on their side to reap the potentially huge benefits of compounding. Young people are more tech savvy generally, but they need to avoid taking seriously sketchy investment tips for quick gains, as such tips often act as distractions besides proving to be wealth destroyers on many occasions. Moreover, how many followers on social media a person recommending a stock has should definitely not be the deciding factor. More self-study about the recommended share must be done before investing. Being young, youth can assign higher weightage to equity in their portfolio. For safer and rewarding investment, youngsters can go in for long-term SIPs in index funds. With age on their side, they can also invest in long-term SIPs in mid-cap funds. Young investors should gradually build a contingency fund also. In addition, borrowed money should not be invested in stock markets. Moreover, young investors should take insurance seriously, as any unexpected and sudden heavy expenditure can completely derail the entire financial planning in a big way if insurance cover is not there. And health insurance policy must also be purchased. It should not be thought that being young and healthy, one does not need it. Those youngsters who are married and have dependents should also invest in life insurance policy. An early start to savings, regular savings, and prudent long-term investment can really help youngsters in a big way in the long run. And when it comes to a place of residence, flat or house should be bought at a young age only if one is sure that the city where house is being bought will be the place where one realistically expects to stay for several years. And when it comes to a relatively quick gain in the stock market with rather low risk, young investors can make lump sum purchases in Nifty 50 index fund or Sensex 30 index fund or even Nifty Next 50 index fund whenever there is significant correction in the concerned index. If such purchased mutual fund units are held, attractive gains can be made as and when the market recovers. With the right approach, young investors can expect to make sizable gains over a period of time. Thank you so much for listening, and just let me add a disclaimer. This video is only for educational purpose. Please do your own analysis before investing. Happy investing and take care. Have a great day. Please don't forget to subscribe. Thank you.